Investing is often associated with the exciting question of what to buy, and yet many people fail to consider the equally crucial question of when to sell. Selling for the right reasons can dramatically improve your performance, and yet many investors find this question very challenging. So in this video, we'll see when selling is a sound decision, but also when it's best to hold on. If you do enjoy our videos, please do subscribe to our channel and like this video. So let's look at when to sell in a bit more detail. Let's begin by looking at reasons not to sell. People often get really worried when their investments fall dramatically in price. They might say, well, it's gone down a lot and I think it could go down further, so I'm going to cut my losses. And then if I want to get back in, I can just buy the stock again or buy the fund again. So let's take a look at an example of that. If we look at the Magnificent 5 stocks and we look at their performance during the global financial crisis, you can see that they sold off almost catastrophically. Nvidia in particular was down almost 80% between 2007 and March of 2009. Over the same period, the Nasdaq was down by about 50% and the S&P was down a little bit more by about 56%. Even the best performing stock in this group, which is Amazon, was down by about a third over this period. So should we have just cut our losses at this point? Well, if we zoom out, we can see that that would have been a colossal mistake. It's unlikely you would have timed the turnaround absolutely perfectly, and the chances are that you would have been caught out by the incredible rally that followed. So even starting from that high point in 2007 and factoring in that catastrophic fall, the annualized returns for these stocks since then have been phenomenal. Nvidia on average has returned about 28% per year, Apple about 23%, and even the worst performing stock in this group, which is Alphabet, has returned about 13% per year. So prices falling are usually a very bad reason to sell, particularly for index funds which are diversified, which always recover. It's simply a question of how long they take to recover. But there are all sorts of other reasons why people choose to sell, and it could just be because of news flow. For example, it might be that unemployment's rising. That's usually associated with a recession. Or perhaps there's been a natural disaster like an earthquake, or there could be a debt crisis, or there could be a debt ceiling crisis in the United States. Those happen regularly. Or as we saw, there could be a pandemic from which the recovery was very rapid and very extreme for stocks. Or it could be something regular like the Fed raising rates or cutting rates. So should we react to these pieces of news flow? Well, for the index investor, the answer is no. It's best to just hold on and accumulate value over time. Yes, there'll be fallbacks, but you can't time your exit in order to avoid those. Once the market's fallen, it's usually already too late to cut your losses. And then you have to find an entry point which is more attractive. Michael Batnick regularly posts this graph of the S&P 500, which shows all of the reasons to sell over time. And yet, while those reasons came one after the other, the S&P gradually increased over time. Yes, it certainly fell, but you can see the long-term trend is upwards. Another reason that some people give for selling is that the thing that they've bought has increased a lot, and they feel it can't go up any further. But for an index investor, if you sell when we reach a new all-time high, it would be catastrophic. Here you can see the S&P 500, and I've plotted yellow vertical bars when the index reaches a new all-time high. And this is for data since 1871. When the bar's blue, the index is below the previous all-time high. Now what's pretty astonishing is that this index has spent about a fifth of its time at all-time highs. So if you had sold when it reached those, you'd have hardly ever been invested during these very strong rallies. So again, for an index investor, this is not a reason to sell. Just hold on and reap the rewards. Now, if you're a single stock investor, let's say that you're buying Nvidia, and here what I've done is I've shown the highest and lowest value for the broker forecast for that stock, and the dashed line you can see is the average broker forecast. Now notice that towards the end of 2021, the value of the stock touched even its highest broker forecast. Remember, brokers are often very bullish about stocks, so when the stock price reaches the most bullish forecast, you know that's a very toppy price for the stock. And sure enough, after that, Nvidia sold off quite severely. Or perhaps if you're a value investor, you'll have filters for your stocks based on the target price beyond which they become expensive. And at that point, it would make sense to sell. So for single stocks, there are reasons to sell when the stock no longer meets your criteria for investment. So this is one way in which single stock investing is quite different from index investing. Another reason that you often see on social media or on YouTube is that some billionaire has sold their stocks. So the implication is that we should do the same. Michael Burry is often used as an example of someone that you should follow who often sells his stocks altogether. Here you can see his 13F filings, which shows he sold everything except for one stock. Another investor people always look at is Warren Buffett. So here's a headline about him selling his Hewlett-Packard stocks. And here's hedge fund manager Bill Ackman, who's got a big short on US Treasuries, with the implication being that we should sell our Treasury holdings because he did. But the problem with that strategy is that we're not billionaire investors, or at least most of us watching this channel, I suspect. In which case, our circumstances are not the same as their circumstances. And that means that copying them probably won't produce a great outcome for us. Plus, they're not infallible. They make mistakes. Even Warren Buffett admits that he makes mistakes. And consider, if they make a mistake in their portfolio, it's not going to make much difference in their lifestyle. Whereas people with less wealth, if they make a mistake, it can destroy their retirement. So just remember that you're not the same as these investors, and it probably doesn't make sense to copy their portfolio, or at least their sales, because this is just not appropriate for you. Now, if you enjoy our videos, then why not learn more about investing as part of our community? That way you can ask a question whenever you like, and you can do that via our chat application. You also have members only videos, which only you have access to, and you get access to our trackers, which monitor macroeconomic data and also marry those to what's going on in markets. To learn more about that, just go to our website, PensionCraft.com. So those were reasons not to sell. Now let's consider good reasons to sell. Probably the best reason to sell is that you need the money. We don't invest for no reason. We invest it because it helps us with our lifestyle. If we do have an excess of savings, then it makes sense to invest it and also to get pretty good returns on those investments, hopefully. But it's not so that you can have a money bath. That's not the goal here. It's not to die with loads of money. It's so that you'll be able to enjoy life more. One time when almost all of us need the money, when we need to sell things, is when we retire, because that's the drawdown phase, and all of our savings up to that point have been leading up to that set of sales. So really, I think this is probably the best reason to sell. Another reason might be that your investment thesis has changed. What do I mean by an investment thesis? Well, whenever you buy something, it's always a good idea to write down in your investment journal why you did so. Because I can guarantee that in 5 years' time, you'll probably have forgotten the exact reasons. What this also means is that when it comes time to sell something, if you feel that you want to, look in the journal to see what your justification was for buying in the first place. And if that reason hasn't changed, then maybe you should reconsider selling. For single stock investors, this is particularly true because there the narrative does change. New competitors enter the market, perhaps the company screws up, maybe it misallocates its capital, maybe the management has screwed up. There are lots of reasons why the investment thesis might change. But if that is the case, then it makes sense to sell. Another reason might be that your circumstances have changed. For example, some reasons why you might need cash would be that you've had children, they're very expensive, or perhaps you've had a divorce, or perhaps you've inherited a large sum of money or sold a company, in which case your risk tolerance has probably increased a lot. If you have more cash, then you can invest more of it without affecting your lifestyle. So in that case, you might want to sell some of your low-risk investments and increase the risk of your portfolio. Another reason I've come across, and it's always tragic when it happens, is that somebody has a terminal diagnosis. They've got a much shorter investment horizon, and so why not sell some of the stuff in your portfolio and enjoy life while you can? And then finally, one reason to sell would be rebalancing. So for example, if you'd have bought a 60-40 portfolio in 2009, so this would have contained 60% global stocks and 40% global bonds. Gradually what happened over time was that the stocks massively outperformed the bonds. This means that if you didn't rebalance, your portfolio would become much more heavily concentrated in stocks. So what started as a 60-40 portfolio would now be an 80-20 portfolio. Maybe that's okay, but probably it isn't, because you probably want to keep the allocation you're most comfortable with, in which case you could sell some of the stocks and buy some more bonds. And that way the portfolio comes back into line with the weights you're happy with. Now with a more complex portfolio, if it contains hundreds of stocks, you'll probably be rebalancing and selling and buying all the time. So that would be another reason why selling would be okay. So I think those are some of the pitfalls to avoid. And just speaking to people one-to-one, there are other reasons they give me for why they want to sell some of their holdings. Some have legacy holdings. Maybe they read too many investment magazines and they built up a huge list of stocks, and they now want to simplify that. Others have a change of heart and change their investment style. So in that case, they also want to sell their legacy holdings and transition to a new portfolio. But in most cases, it pays to just forget the past. Unless it incurs a massive tax cost or perhaps transaction costs, it usually makes sense to do the transition as quickly as possible. Focus on what you can control, which is the allocation today, and design your portfolio as if you didn't have any history at all, as if you were starting with a clean piece of paper. But hopefully this video has helped you to decide when is a good time to sell and when is not a good time to sell, and what the reasons should be for that. Now don't forget, if you do want to learn more about investing, a very friendly environment in which to do that, a very collaborative environment, is as a member of our community. And you can learn more about how to do that by going to our website, PensionCraft.com. And, as always, thank you for listening.